Hello, Assalamu alaikum. This is me, Zishan Hassan. I'm the tutor of ACCA papers, F7 Finance Reporting, and SPR, right? And in this video, as you can see, the topic is IAS 16 Property Plan and Equipment. Um, why I'll be covering topic, this topic as a demo, as a free content, because it is one of those topics which is regularly tested by the examiner. Either it is paper F7 finance reporting, or either it is paper SPR strategic business reporting. So that's why I choose to give you it as one of the free topic, right? Um, so let's move on and straight away start with the standards. Firstly, what is property, plant, and equipment? We need to know what is non-current asset. Before that, we need to know what is non-current asset. So, for that, what I will say, resources controlled by an entity for more than one accounting period. And it is expected economic benefits will flow to entity. What is the definition? Resources controlled by an entity. So the question is, why not use the word own, control? Why not they use the word own? Why don't they use the own word in, and why they use control? The reason is, you will study the topic, the standard IFRS 16 leases, right? And in leases, although we do not own the asset legally, right? But still, we record them in our financial statements, um, recognize them. This is the reason we use the word control instead of own, right? So then I'm saying by an entity for more than one accounting period, that means more than one financial year. It can be 2 years, it can be 3 years, 4 years, 5 years, 6 years, whatever. And it is expected economic benefits will flow to the entity. That means entity will get any of the consideration for this, right? The example of these is number one, land, building, material, machinery, etc. are the example of non-current assets. So far, so good. I hope you get it till here. Now, when to recognize the non-current assets or these property, plant, and equipment, according to standard, we need to fulfill two conditions. Number one, it is probable that future benefits will flow to entity. Number three, costs can be measured. Reliable. These are the two reasons that assets can be, they can be recognized. Two conditions need to fulfill, and then we can recognize the asset by making this double entry asset debit, cash, or you can say bank credit. So far, so good. That's how we can recognize the non-current asset. Now, now, next thing which we need to look at is initial cost recognition. The question is which costs can be initially recognized in the cost of the asset. So initial cost recognition and the cost of the assets which we cost can be capitalized. Number one, it can be list price. It can be list price. What is list price? The list price is now which is so not uh, exclude it, it is exclude of the price, and then less we will deduct the trade discount. Okay, firstly what we will do, we will consider as a total list price, right? What is list price? List price is any of the asset costs excluding of any discounts, right? Cost without considering a discounts is a list price. So then we will deduct the discount. Now the question is the trade discount and cash discount. I So I hope you guys remember we have two types of discount, trade discount and cash discount. Do you remember the difference between the two, between the trade discount and cash discount? Do you know the differences, folks? Well, let me tell you. Firstly, what is trade discount? Suppose you went to a supplier and he did tell you that, folks, if you buy 50,000 units, I will give you 5% discount. If you will buy 50,000 units, I will give you 5% discount, and this discount obviously can be deduct from the cost of units, or you can say cost of products directly. That's trade discount. Now the cash discount. What is cash discount? The supplier told you that, buddy, you has the 60 days credit period, but if you give me payment within 15 days, I will give you extra 2.5% discount, right? So that's the cash discount. If you, the thing is, we will only deduct the trade discount from the cost of the asset, not the cash discount. Why so? Because even we are not sure either we're gonna take the cash discount or not. So that's the reason that we will only consider trade discount, consider or will deduct from the trade discount from the cost of the asset and not the cash discount. I hope you get the pointer here. Next, we will add the freight charges, that means the traveling cost of those assets into the cost of the asset. We will also consider, we will add the installation cost into the cost of the asset. Pre-production testing will be added. Add the professional fees such as architect fee into the cost of the asset, because without that we cannot start the work, obviously. Add non-refundable taxes such as the taxes on the purchase of land or building, right? So that will be considered as well. Then we will add the dismantling cost. Now, what is dismantling cost? The question is, what is dismantling cost? Suppose this boy went here on this land to do some mining work. And what happened? Here he got the letter from the government. In this letter, it was stated that, dude, if you want to start the work on this land, you have to sign this paper in which you will agree that you will bring this land into its original condition. Before starting the you have to sign it, obviously. Now can we proceed with the work without signing this paper? No, that means it's going to be our obligation to bring this land into our original condition. We are done with the work over here. Now suppose we gonna work over here for 3 years, right? And after 3 years we have to pay them $100, and the interest rate is 10%, right? So let me take out the calculator. 100 into 100 into power 3. Sorry, 1 divided by 100. So 10% is the interest rate, and we have to pay them $100 after 3 years. So we have to take out the present value. That is the present value of those $100. How we will do that? 100 divided by 1.10. That is our interest rate into power 3. That is means after the 3 years. So the present value will be like 75. My present value is like 75.13. Now I will add 10% every year. $75.13. Interest rate is 7.51 plus 75.13. that is 82.64 in year 2. 82.64 into 10%. 8.26. Sorry, that's year 1. No, in year 2. 82.26. Sorry, 64 plus the interest is 10% is 8.26 plus 8.64. It's 90.90 into 10%, 9.09, right? So plus 90.0. It's almost 100, right? 9.900. So 100 in 3 years it will get the 100. Take out the 100 and pay officials and get rid of this. So the cost. I hope you guys get it till here. Right? Then. Next, we will look at what is subsequent expenditure. Next, we will look at what is subsequent expenditure, right? Okay, subsequent expenditure. Suppose we bought a asset for $100,000, which has a life of 5 years. Okay, so that means depreciation will be 20,000 in the year 1, and it will have a net book value of 80,000. In year 2, again, it depreciated for 20,000. And now it has a value of a net book value of 60,000. In this year 2, we incurred an expenditure of 20,000, due to which number 1, due to which either its useful life is increased, number 2, either its efficiency is increased, either number 3, it's operating cost is decreased. For example, now it has a life of 3 years, but due to that expenditure, its life increased to 7 years. Earlier, it was producing 10,000 units. After this expenditure, it's producing 15,000 units. Or earlier, it was giving us a cost of 10,000. Now it's giving us a cost of 6,000. So any of these three, any one can happen, such expenditure is subsequent expenditure, and remember, subsequent expenditure will be capitalized. So far, so good. I hope you get it till here. Now, let us look at the one of the important thing, that is the depreciation. Let us revise the depreciation. What is depreciation? Number one, it is a non-cash expense which we recognize against the cost of asset to fulfill the requirement of matching concept. Right now, what is matching concept? I hope you guys remember the matching concept says that everything which just generating the revenue, which is giving us the economic benefits, has a cost, right? So this is a cost which we recognize against the asset because we believe that they give us the economic benefits. We have two models of depreciation. One is straight line. Depreciation method, mostly we deal with them. And number three is reducing balance method. Second method, right? Now straight line method. Let us revise the straight line method. What is the straight line method? Simply, it says cost less scrap value divided by useful life. For example, ABC company bought an asset on 1st January 2000 X1 for 100,000. It has a useful life of 4 years, scrap value 20,000. Requirement, the depreciation, simply. Now, how we will do that? What was the cost? 100,000. What was the scrap value? 20,000. What is the life? 4 years. So, what is the depreciation? 20,000 per annum. Isn't it easy? Now, next method, which is reducing balance method. Okay, one more thing which I need to tell you. Straight line method believes that throughout the life of asset has a equal usage, so they deduct the equal amount every year, as you can see over here. While in the reducing balance method, it says that it gives the more amount in the coming years and then more benefit in the earlier years, and later on it gives less benefits. So it will give you less in the later on in the life of the asset. Now let me show you how it applies. Example: A, B, C company bought asset uh, of 100,000 on 1st Jan 2000 X1, life 5 years, depreciation 20% per annum, require depreciation. Now, see, asset cost X1, 100,000, depreciation 20% is 20,000 over here. We'll get net book value of 80,000. Okay, 80,000. Net book depreciation is 20% again, 16,000. 80,000 into 20% is 16,000. So 80 minus 16 will get 64,000. Then we have depreciation 20%. 12,800. Sixty-four thousand minus 12,800, we get 51,200. Then depreciation again is 20% is into 20%, 10,240. Minus 10,240. 41,000. Then depreciation 20%. 41,000 into 20%, I'll get 8,200. $41,000 into 20%, 8,200 minus 8,200. That's 3,800, and so on. It will go like this. See, now see, let me prove my point. First year, it deducted 20,000 depreciation. Second year, 16,000, 12,800, 10,240, 8,200, and so on. Right? See, in earlier years, it's deducting more amount, then less, then less, then less, then less. That means my point is true, isn't it? So I hope you get it till here, folks. And now, what I'll do, simply the next thing which we need to look into for this standard is the next point. Revaluation. Next model, revaluation model, right? And in revaluation model, it says what is revaluation? Revaluation means, you all know maybe that assets got revalue, their values goes up or down without any changes into the asset due to market. The market values of assets goes up and down without any changes of it. That thing is known as revaluation. We have four, you can say, scenarios in revaluation. First one, first time upward revaluation. For example, we bought the asset for 1,000 and then we have asset revalued to 1,500. So asset, when we purchase the asset, asset value is asset debit 1,000, cash credit, and then cash credit 1,000. Then asset got upward revalued by 500. So asset debit 500, revaluation reserve credit 500, right? Now, what is revaluation reserve? Revaluation reserve is a part of equity. Why we recognize the gain in equity? Because, we didn't sell the asset. We didn't recognize the gain in actual, right? So that's why we brought the gain into equity part, which is known as revaluation reserve. Then next scenario. First time downward revaluation. $1,000 and as it got down by 250 into year one, year zero, year one. Right now, when we purchase the asset debit 1,000, cash credit 1,000. Now asset goes down by 250, right? So asset will be credit 250. As it goes down, so we will debit the profit and loss account. We will expenses by 250. Now the question by a innocent student is that when we got the gain, we recognize the gain in equity. And when its values goes down, we're facing loss, we recognize it as an expense. Why is that? Simply, the reason is the prudence concept. The prudence concept which says, do not recognize the gain until or unless we actually gets it, but recognize the loss or the expense until soon as we foresee it. So that's the reason we recognize the expense in this scenario. Third scenario. First upward, then downward, year one, 1,000, year two, as it goes up to 1,500, and then it goes down to 750. So simply, first entry is very similar to the first. We are doing asset debit, 1,000, cash credit, 1,000. Yum. Then asset goes up. Asset goes up. It's similar to the case number one. Asset debit 500, revaluation reserve credit 500, right? Now asset goes down by 750, right? So what we will do, see over here, asset credit 750. Till now, how much we recognize in the revaluation reserve? 500, isn't it? Right? See carefully. So what we will do, we will de-recognize the revaluation reserve by debiting it by 500. How much left? 250. Simply, we will brought that to the expense, profit and loss account, debit, that is expense 250. I hope you got this. And next, and the last scenario, first downward, then upward. Downward, then upward. Year 0, 1000, year 1, 750, then year 2, 1500. Asset debit 1000, cash credit 1000. Then it's like scenario number 2, P&L debit 250, asset credit 250. Now this last scenario, asset goes up by 750. So asset debit 750. How much expense we recognize till now? You can see over here. Oh, sorry. Just a second. How much expense we recognize till now? 250, right? So we will reverse it. We will recognize it as an income over here, P&L credit 250. Right now, how much left? 500. That will be brought to the revaluation reserve. So revaluation reserve will be credit 500. Right? So that's the treatment for the scenario 4. And I hope you get it till here. So now, next point we need to know is depreciation of revalued assets. Once an asset has been revalued, the following treatment is required in case of depreciable assets. Number 1, depreciation must be charged based on valuation less residual value over remaining useful life. Okay, so depreciation must be charged based on valuation less residual value over remaining useful life. The whole charge must go to the statement of profit or loss for the year as an expense. Okay. Now, then And annual reserve transfers may be made, right? And annual reserve transfer may be made. What does that mean? It means revaluation surplus to retain earnings for extra depreciation on the revalued amount compared to the cost measured as the difference between depreciation charge based on revalued amount and the charge based on historic cost, right? And transfer disclosed in the so sheet, that means statement of changes in equity. What requirement journal entries will be needed? Profit and loss expense, that is your depreciation charge, will be debit. Accumulated depreciation, that means depreciation which has been charged till now, will be credited. And on the other hand, revaluation surplus will be debit and retained earning will be credit, right? How we will do that for get the better understanding, let's do the example on it. Okay, now let's do the related example. On 1st April 2008, the fair value of ABC property was 100,000 with remaining life of 20 years. The company policy is to revalue its assets at each year, and at 31st March 2009, the property was valued at 86,000. ABC does, okay. The balance on the revaluation surplus at 1st April 2008 was 20,000. That is the opening revaluation reserve, right? So, which relates entirely to leasehold property. Okay, now ABC does not make transfer to realize profit in respect of excess depreciation, though the requirement is prepare extract of ABC financial statement for the year ended at 31st March 2009, reflecting above information. And the second requirement state how the accounting would be different if opening revaluation surplus did not exist. So bang on for the solution now. And how we will do that? Simply let's move to the workings first. First, we will do the working. Working one related to the depreciation. Straight line depreciation, 100,000, life is 20 years. No scrap value was given, so it's 5,000 per annum. Now the second working, revaluation. Carrying amount of asset at 31st March 2009 is 95,000. How we get that 100,000 less 5,000, right? It's a 95,000. Then leasehold valuation. At 31st March X9 is 86,000. So we had the loss on revaluation, that is 9,000. Let us make the extracts known. Simply. Firstly, what we will have, statement of profit or loss and other comprehensive income. In it, first we will have depreciation. How much was the depreciation? 5,000. Then OCI in other comprehensive income. OCI, we will take the revaluation loss, which was 9,000. Next extract is related to statement of financial position. Extract. Firstly, we will have non-current assets, leasehold property, leasehold property. At valuation, we had 86,000. Revaluation surplus, then we have 20,000 minus 9,000. The revaluation loss was 11,000 over here. And the next one, statement of changes in equity extract. Statement of changes in equity extract. Balance at 1st April. X8, 20,000. Revaluation of leasehold. We already done the working do for it. What was that? 9,000. Simply. Now the balance at 31st March X9. 11,000, right? So that's the extract for she statement of changes in equity. And as far as the requirement 2 is concerned, what will be our solution for it? If opening revaluation does not exist, then the revaluation loss of 9,000 would need to be taken through statement of profit or loss as an impairment expense. We are done with this example, and I hope you guys got the concept more clearly now. The one of the last topic of this standard is disposal of revalued non-current assets. Disposal of revalued non-current assets. Now, the profit or loss on disposal of revalued non-current assets should be calculated as the difference between net proceeds and the carried amount, right? So how we will do that? Simply sale proceeds less carried amount, and we will get gain or loss on disposal. Simple. Now, the steps of disposing of revalued assets. The main thing, steps of disposing revalued asset. Number one, it should be accounted for in statement of profit or loss of the period in which it occurs. Q, the remainder of the revaluation surplus relating to this asset should not be transferred to retained earnings. The remainder okay the remainder of revaluation surplus relating to asset should now transfer to retain earning, right? It would not affect other comprehensive income, which is only altered when the asset is actually revalued upward or downward, right? Now, for better understanding, again, what we will do, we will do an example. Let's jump on it. Okay, now ABC purchased a property costing $750,000 on 1st Jan 2004 with a useful life of 10 years. It has no residual value. At 31st December 2004, the property was valued at 810,000, resulting in a gain on revaluation being recorded in other comprehensive. Revaluation being in a gain of revaluation been recorded in other comprehensive income of 135,000. Right? There was no change in its useful life. ABC does not make transfer to realized profits in respect on axis, resulting in gain of revaluation being recorded in other comprehensive assets, revalued assets, right? On 31st December 2006, the property was sold for $900,000. Now the requirement is, how should the disposal on previously revalued asset be treated in financial statement for the year ended 31st December 2006. Now, simply what we will do, profit on disposal, the sale proceeds 900, valuation was happened at 31st December X4, as we can see over here, 810. Now less the depreciation. What was that? 810 divided by remaining life, which was 9 years, and we will consider it for 2 years, obviously, because we use it for 2 years. So 180 will be deducted from here. Overall carrying amount at 31st December at 6 is 630. We'll get 270 profit on disposal, right? Now transfer remaining balance on revaluation reserve will be, revaluation reserve will be debit by 135, and Retained earning will be credited by 135. I hope you get it till here, and that's it till this part. And finally, we will discuss the one more thing, the review of useful life, review of useful life. A review of useful life of property, plant, and equipment should be carried out at each financial year end, right? A review of property, plant, equipment should be carried out at each financial year end, right? Um, and and depreciation charge for the current and future period should be adjusted if expectations have been changed significantly from previous estimates. Okay, so next thing is depreciation charge for current and future periods should be adjusted if expectations change significantly from previous estimates. Okay, from previous estimates. Changes are changed in accounting estimates are accounted for prospectively as adjustments to future depreciation. Last thing which we need to look at in this standard is complex assets. Now, what are the complex assets? Assets which have more than one component and every component has different useful life. For example, this plane. Sorry, my drawing is not too cool. So that's it's the plane, you know, the cockpit. Cockpit life has 7 years. The engine life has 3 years. Obviously, both engines will have a life of 3 years. The interior has a life of 1 year. The interior has a life of 2 years. See, these are the different components which have the different useful life, and by uh, clubbing all of those components into one, we get one asset, which is aeroplane. Such assets are what? Complex assets. I hope you get it, and we are done with the IAS 16. I hope you understand the concepts in the IAS 16 property plan and equipment. If you have any questions, guys, you can ask me in the comment. Please do like the video, do share with your friends, and if you want to study either F3 finance accounting or F finance reporting F7 or SPR strategic business reporting, you can contact me on my WhatsApp number, which is given in the description, or also you can contact me on my Facebook page AccountanSea, on my website AccountanSea.com, or on, as I said, you can WhatsApp me which is plus 923323005199. Let me mention over here as well, plus 923323005199. See ya, folks, and take care.